Some breaking news that just crossed our desk. At-home fitness player Tonal announcing that NBA great LeBron James is now an investor and brand partner of the company. James will appear in Tonal's new advertising campaign as well. Joining us for our first on Yahoo Finance interview is Tonal's founder and CEO, Aly Orady. Aly, good to see you again here. Pretty big development for you on LeBron James. How did you score him? Because James is notoriously picky on who he invests with. Aly, I think you're on. There you go. I'm sorry, I thought you were on mute. Go ahead.
No, thanks. It's something we're extremely excited about. The relationship with him started about 18 months ago when he first joined Tonal as an investor. And how it started isn't all too different from other athletes who've invested. We have about 20 to 30 professional athletes who've invested in our business. And the story is always they got a Tonal, they used it, they fell in love, and then they wanted to invest. And over time, we've just built that relationship, and being someone who works with equipment basically his entire career, has been around fitness his entire career. When he sees something like Tonal, adaptive digital weights, something that's incredibly efficient, something that's incredibly data driven, he had to use it, and a partnership made perfect sense. He was excited about it, and we were able to make this happen.
Aly, you see the list of athlete investors you have: Steph Curry, Drew Brees, Serena Williams. Is LeBron now the biggest athlete investor in your company?
LeBron is definitely he's without a doubt one of the greatest athletes of all time. We're really, really proud to have him involved in the business. We're excited. He's excited. And you know, the most important thing that I can say about this is he's been using Tonal to train. He actually believes in the product. It's something that he personally uses. He views strength as a foundation of greatness. And this is something that came up in a lot of our interactions with him. And being able to get stronger with the most advanced piece of equipment ever created is something that he's really, really aligned with. This is something that, of course, we've seen with the likes of Serena Williams and Steph Curry and dozens of other athletes who use the product for that exact same reason. And he's just adding one of the greatest athletes of all time to our roster, and having him be involved with us in this capacity is just a huge, huge step for us.
Hey, Aly, it's Julie. Obviously, when you get these folks sign on as investors, it's something that can potentially prompt more people to sign up and buy the product. How many people have bought the product? How many of these have you sold? And how has your sales growth been?
Well, we have not been talking explicitly about numbers in terms of dollars sales. But what I can tell you is we did last year announce that we grew 8x year over year, which is massive growth. In January of this year, we raised $250 million at a $1.6 billion valuation. And we've seen significant growth since then. And so when you're looking at those valuation numbers and the multiples that you would assume are behind them, you can extrapolate the rate at which we're growing and how many Tonals we're selling. I'm just going to tell you, it's a lot. It's significant.
Aly, do you expect some form of shakeout in this at-home fitness space? I see you guys, very innovative product. Peloton, very innovative product. But I see something like a Mirror, I would say not too innovative, and you see other competing type products out there. Ultimately, over time, is there just two major players in the space?
Well, we are the leaders in connected strength. We're also the leaders in intelligent fitness. One of the things that we did differently from everyone else in the sector is our aim to bring a personal trainer into the home rather than just a group fitness experience. We did that by bringing a lot of data to bear, by building AI and personalization. And we really view that as intelligent fitness, not just connected fitness. So we're forging ahead, and we're leaders in multiple dimensions. We've built all sorts of moats around our business. We filed over 45 patents to date. Of course, there is one business that you mentioned, Peloton, which is significantly larger at this point, but we're growing faster than they historically grew. And then you're right. After that, there's a lot of smaller businesses who are building more point or niche solutions. And I do expect that that's going to shake out over time. I don't believe this is a winner-take-all market, but I also don't believe it's a market where we're going to have room for a dozen different players.
And Aly, news out today that Apple is having trouble just getting components for its iPhones. I mean, how does your supply chain look in this environment?
I'll just tell you, it's a lot of work to secure supply. We've tripled the size of our manufacturing team just in the past 12 months. And the 12 months prior to that, we 10x our manufacturing capacity. We brought a second factory online last year, bringing another factory, a third factory online in the next few months. And a lot of this is just about securing materials, securing capacity, keeping supply chains moving, and logistics, just moving product around the world and across the country. It's hard work, and it's where we're making a lot of investments. The vast majority of our investments are either going to marketing, brand, operations, or content, where you might have heard, but we recently announced live content on our platform as an addition to the many forms of content that are available to our members.
And Aly, I know you've been asked this before, and I'm going to ask it again, what the IPO plans are. And if you're not ready to IPO now, sort of what you're looking for, what would be the trigger? What would be the thing that would mean that you're ready to go there?
Well, we've been building towards it. In the last 6 months alone, we brought in a number of new executives into the C-suite, and operations, product experience, technology. And a lot of that is about readying the company for an IPO. We still have a lot more building to do in terms of operations, finance, infrastructure, and a lot of the compliance things that you need to be public. But it's something we're working towards every single day. We're going to look for that moment in time where being a public company is beneficial to us and is not a distraction. Being public can often take a lot of management energy, and right now we're growing so fast that we just want to focus on supporting that growth rate. And really supporting our member base, which is incredibly passionate about our product. We have a net promoter score that is pretty stable at 85. We have the highest engagement in the sector. And those are metrics we certainly don't want to lose track of just to become public. We'll become public when we can pull off being public, tap those kind of public capital markets, and make sure that our business is solid throughout the entire process.
Well, we'll see you back on Yahoo Finance when that big day happens. Tonal founder and CEO Aly Orady, good to see you.
Nearly half of American workers are either actively looking for new jobs or considering starting a new job search. That's the finding of Pulse of the American Worker, which is a new survey conducted by Prudential with the help of Morning Consult. Rob Falzo is joining us now. He is Prudential Financial's vice chair. Rob, it's great to see you. There has been sort of this central mystery, right, at the center of what's going on in the jobs market here. And I think that this survey gives us a little bit more insight into what's going on. I mean, that's an awful lot of people who are thinking about switching jobs here. What do the findings tell us about what's behind it?
Well, first, some confirmation coming out of the labor statistics yesterday, right? So record number of resignations, quits, 4.3 million. And actually, Julie, if you look at that number over the last 6 months, it's like 20 million people have resigned their jobs over that period of time. That's 15% of the total labor force. It's probably closer to 20% of the private sector. And so, what's driving it? Well, first, working in a remote environment has caused something I call disassociation. So individuals are sort of less attached to their jobs, to their companies, to their coworkers than they were when they're actually in the office and able to work with those individuals. And that disassociation has sort of set a stage for them re-examining what they're doing. And as they think about their careers, what's on their minds is, outside of compensation and benefits, which is always important. And frankly, in this environment, the benefits piece of that is probably our earlier survey is showing a higher priority even than the compensation side of it. But beyond that, it's around career development. Many of them are completely rethinking their careers and the direction, thinking about job switching, and flexibility that they want on a go-forward basis. And many of those things they haven't been able to fully achieve in their existing positions during the pandemic.
Rob, 71%, at least according to the survey, 71% of managers with open positions say the applications they are receiving are from workers that don't have the right skills, or the skills gap we continue to focus in on. How can we close this gap?
Well, so it's, I'm calling it a canyon, Brian, as opposed to a gap, because it's, it started out as a skills gap. And what's happened as a result of the pandemic, you've seen an increasing widening of that. And our survey showed, 30%, and early in our surveys, 30% of the individuals who responded said, I don't know that I have the skills that I'm going to need for my job. That went to 50% in a survey we did a couple surveys ago. And now that number has gone well north of that in terms of individuals who feel like what's happened on the technology and data front has sort of outstripped where they are. So it's going to require an investment that we make in skilling American workers. And I think we, as I call it, all of the above. It's, corporations have to lead. We have to invest in our talent because the reality is we're not going to be able to hire our way out of this problem. So we're going to need to train our way out of it. But I think it goes beyond that. I think public policy and, institutions, academic institutions and others need to be engaged in creating the opportunity for individuals to do skilling in order to make themselves relevant to the jobs that are getting created today versus the jobs that they had. What's interesting is we have this phenomenon of resignations. At the same time, we've also got almost 10.5 million open positions that are unfilled. And that's, as a result of that 71% not being able to find talent with the right skill set.
And one of the other interesting, relevant findings of the survey is that 58% of the folks you surveyed say it's been harder to learn new skills in a remote environment. Now, I know a lot of companies, even when people are in the office, do sort of virtual trainings and such. And so I wonder if a finding like this might cause them to rethink that a little bit.
Yeah, so you need to make investment in your training because, while a lot of training, Julie, to your point, can be done remotely and online, and in fact, I think the majority of it actually can be done that way. There is an absence of, something that's absent when you don't have the opportunity to engage live with people. Having said that, I think what's really happened, Julie, is that as a result of what we've been going through, both the pandemic and its economic repercussions, that employers have kind of stepped back from their engagement with their employees and their training of the employees. And so if those programs are there, they haven't, employees are having a hard time finding the time to fit them in because they're all working, frankly, longer and harder remotely than they were when they were in the office. And employers have, focused on other important issues and perhaps have not invested in keeping that information, that training as fresh and relevant as it ought to be. And the economy has moved dramatically in the last 24 months. And so if you had training programs that you had stood up 24 months ago, they all need to be, if not brushed off, thrown out. And you need to reorient more toward, what the needs are for, if you look at company by company, we can look at, where we're having challenges filling roles and gear our training to develop skills to fill those roles.
And the survey discusses, Rob, this erosion of corporate culture may be causing more people to leave. Is that one of the biggest risks to a full economic recovery, that companies lose their soul and they're just not as productive?
Yeah, I think that the challenge, I think about it from two perspectives. One is as employees are less engaged with their organization and the culture, they're less engaged with their work. That's going to lead to lower levels of productivity. That's not a good thing for us. The second part is that if to the extent we're not investing in the skilling of those employees, they're not reaching their potential. If they're not reaching their potential, we're going to have a suboptimal GDP versus what we're able to do with the labor pool that we've got. So again, it's about investing in those individuals. And I think on the first part of that, we need to bring people back into the workplace, but probably bring them back in a way that allows them the flexibility that they've enjoyed while they've been remote so that they can continue to benefit both from the remote environment and from what you get from being live and in the workplace.
Prudential Financial Vice Chair Rob Falzo, always good to see you. Have a great rest of the week.
Let's bring in Helane Becker, Cowen Senior Research Analyst. And Helane, you were just listening to Adam's conversation with Ed Bastian. Fuel prices certainly going to be a significant headwind, not just for Delta, but all the airlines moving forward. How are you looking at that factor in the context of travel demand largely starting to tick up higher?
Yeah, thanks for having me on the show this morning. Fuel costs are going to be a major negative going into in the fourth quarter, and then depending on what happens into the first quarter as well. So it takes about 4 to 6 months for airlines to start to recoup fuel cost increases in their revenue. They don't have fuel surcharges the way FedEx or UPS do, or truckers that would allow immediate recovery. So that is definitely a major issue for the industry, and it will forestall a return to profitability. We have Delta losing money in the fourth quarter again. And in large part, it's a combination of higher staffing costs. You heard Adam say that they did say on the call this morning also they were hiring 8,000 or had hired 8,000 people. They had 17,000 people retire at this time last year, by this time last year, owing to the pandemic. So when you think about that, that should be a positive on the labor cost side, but starting salaries are going up in order to attract, and then in order to retain, they're having to give people salary increases as well. So you have both of those things as well as fuel, and then maintenance costs. Nobody's really talked about the fact that Delta's bringing back about 150 aircraft into the network over the next 6 months to be ready for the summer, because what they said is, yes, the US borders are reopening at some point in November, but Europe-US traffic is not a big winter thing. It's a summer thing. And so to get ready for next summer, they're bringing these roughly 150 aircraft back into the network, and that's going to cost money as well. So you see a lot of cost pressure, and you don't really have the revenue offsets yet. And you're not going to get those revenue offsets because even though demand is very strong, demand is really strong because fares are relatively low. And we think that those fares will be low, except for the week around Thanksgiving and from about December 15th to about January 4th. And then fares will come down again.
Yeah, ain't that always how it is? But Helane, good to chat with you again on the show today. I mean, when we're talking about the holiday season, earlier in the pandemic last year, we're talking about how important that was, right, to keep this going, and how important it was for all the airlines looking forward to an opportunity to raise prices. This time around, as you're kind of laying through the costs that are going to be hitting all the airlines, I mean, which ones are still your favorites to kind of lean in on here? I know we're going to get the updates more closely as earnings season rolls on, but I mean, which ones are you looking at to maybe benefit around the holidays, or maybe have a little bit more pricing pressure, shall we say?
Yeah, no, well, I think from a revenue perspective around the holidays, I think the industry benefits in general, because I think people might have been willing to give up one holiday which is last year, but they're not willing to give up 2 Christmases or 2 Thanksgivings with family. So I think you're going to see that demand, and I think it's going to be beneficial to revenue. But really for the fourth quarter, we're talking about 4 good weeks, and the rest of it, because you don't have that business traffic back, and you don't have really international except for maybe 6 weeks, we're really not going to get that benefit on the revenue side. No, so that would argue right into year end, investors should be focused on domestic leisure airlines still. So that would argue for Allegiant, Spirit, Frontier as our buy rated stocks. And then as you think about going into 2022 and the market kind of thinks ahead 6 months at a time, then you really want to start thinking about pivoting to United, American, and Delta, because you are going to get that strong, what we've called a jailbreak, the whole strong pent up demand. People are tired and they want to go places. And as things people are tired of being cooped up, locked up, whatever. and as you think about that recovery, we think we're going to have a really good summer 2022. As people return to office, they'll have to come back from wherever they've been living. And if they don't want to move back to the, New York area or Chicago or wherever they're living, they want to stay where they are, they're going to still have to commute back a few days a month. So you'll see that hybrid kind of traffic. That's kind of a hybrid business traffic. We've said business traffic comes back 80 to 90% of the way to pre-pandemic levels. I think there's a group of people who probably won't travel. I think there's conferences when you think about, instead of sending 4 or 5 people or 7 people, they'll send 2 to 4 people. I think young people who don't have a network yet will continue to travel, because that's how you build your network. In an industry, you go to conferences, but I think people will be more judicious about what conferences they attend. And I think all in the back of their minds is, I think at this point, COVID is endemic rather than pandemic. And I think we just have to say, this is going to be with us. We have to live with it. And we have to get back to our lives and move on from some of these like rules and regulations that may have made sense when things were really bleak, but may not make so much sense right now.
Helane, I know that, Southwest is one of those airlines you've been watching closely. I know you've liked that as a stock specifically, but I wonder what you make of what has played out recently with the cancellations across the board. Initially seemed to be it was about the pilots union. Now it's not necessarily. But is that what we saw? Is that specific to Southwest, or you think this just shows just how tight things are within the airlines industry, whether that's on the labor side or just the operational side?
Yeah, that's a great question. So I think you're right. You have just hit the nail on the head. It's an operational issue. The airlines have to think about how much they can exactly support, what the network can support. Southwest says, the pilots say that their sick rates were normal and weren't excessive, and it was not about the vaccine, as has been reported, that it was just pilots being out of place. Management says it was a combination of poor staffing at air traffic control towers and weather in Florida. So whatever the underlying reason was, the issue for Southwest and other airlines is they've cut back so much capacity because of the pandemic and because demand was slower to recover. And then you had recovery in the summer, then you had the Delta variant that caused a decline in traffic again. You don't have the excess, and you're flying relatively high load factor. So you don't have that excess capacity on the network. When things go wrong, you don't have capacity to backfill. And then when crews get out of place, that's really the big issue, that because Southwest doesn't run a hub and spoke, it runs a point-to-point network. It winds up having a lot of crews in places where they don't have a lot of flexibility. So you have to wait for the crews to retime. They need to have, the rule is 16, 13, 10, 16 hours of during the day, 13 hours of overnight, and then 10 hours of rest between those shifts. So if you're at a place and you've only rested for 8 hours, you have to wait 2 more hours before you can take the flight. I think Southwest ran 400 or 500 actually empty aircraft to position, what we would call positioning aircraft on Sunday and Monday in an effort to get the network back up and running. And we've seen this with other airlines. When you run low numbers of flights, but supply is low, but demand is high, as it's been. I mean, I think that's if you could find a silver lining, it's that demand has been so strong that it displaced all these people that were trying to get to where they were going over the weekend. So, but to your point, they need to think about, the industry in general just needs to think about what's the level of slack they can afford to fly to recover from things like this.
Helane Becker, Cowen Senior Research Analyst. Always good to get your insight. Appreciate the time.
Welcome back to Yahoo Finance Live. In today's Crypto Corner, non-fungible tokens, or NFTs, are continuing to explode in popularity. Sales of NFTs, in fact, notched a new record in the third quarter to hit more than $10 billion in total sales. That was up 8-fold from the prior quarter, according to a tally from DApp Radar. Some of that might be pure speculation on random digital collectibles, but some of it is coming from some big name brands working on wearable products being sold in the metaverse. The latest examples of just that are coming from the fashion world, with the likes of Dolce & Gabbana, their physical crown coupled with a digital version selling for more than $1.4 million at a recent auction. And for more on the potential upside of NFTs in the fashion space, happy to welcome back into the show Megan Kaspar, Magnetic Managing Director and member of the group who won that Dolce & Gabbana crown, alongside Natalia Modenova, the co-founder of DressX, a digital startup helping major fashion names offer 3D wearable NFTs for customers through their app and elsewhere around the metaverse. And guys, appreciate you coming on here to chat with us today. And when we look at this one, Megan, I should kick this off with you and note that you are an investor in DressX, hence why we have you both on the show today. But talk to me about why you're so bullish on 3D fashion, wearable fashion, particularly in the NFT space, and the future prospects it offers in the metaverse.
Well, for one, Zach, the fashion industry alone is $2.7 trillion. And we foresee that at least doubling over the next 2 decades because of digital fashion. Digital fashion wearables give a new utility to fashion in general, and it takes fashion to a sustainability level where all the fashion that you're wearing, kind of like the earrings I have on in the digital world, are not produced physically. So it becomes a very large ESG investment. And these NFTs, the majority of NFTs right now are all in the Ethereum ecosystem. So that's another proponent that's propelling the Ethereum market cap. But we're going to see more NFTs proliferate, I think, just in specifically fashion. So there's 12 large categories in NFTs, but fashion alone has the largest potential for disruption.
Yeah, I mean, this is the first time we're showing NFT. Thank you for sporting them on the interview today. This is the first time, certainly at Yahoo Finance, I think the first time in a few places. And Natalia, I mean, when we look at the opportunities here, you guys are working with names that people recognize in fashion to build these things and offer them out to the public. I mean, talk to me about the demand you're now seeing from those companies that may not be used to doing this and kind of their excitement in joining in the wave.
Sure. So our goal at DressX to open up the new domain for fashion brands and to open up the new category for fashion brands, which is digital fashion. And there is a space for luxury digital fashion and mass market digital fashion. Of course, sustainability aspect is very important for us from the day one because a digital item emits on average 97% less of the carbon footprint than the physical one. So we believe that in many use cases, it is viable and worth it to switch into wearing digital fashion. And it's also democratization of fashion. But with NFTs, we open up the opportunity of having a luxury category for digital, because with NFTs, it is unique and it is possible to open up the secondary market and resell opportunity. Resale models are growing, and this is something that driving the traditional market. So we know about companies like StockX, Real, and all this model, it's growing. And now fashion industry recognizes that, but definitely in digital fashion, this is something that is going to be a big market as well. There is a data that 9% of clothing is purchased for the sake of content creation. And if we turn this 9% on consumption of digital fashion, that's already a big market. And gaming industry and the rise of the virtual worlds also open up this big opportunity. And recently we finished the auction with Balmain, where the unique fire flame dress was sold for $10,000, and only the owner of this NFT, it was only digital, and only the owner of the NFT will be able to wear it in AR, in augmented reality, just the way that I'm wearing this hat right now. And this is a great new universe for NFTs and wearing and actually using digital assets that you're owning.
So what kind of price range are we talking about? I mean, I realize that the case for digital use, but at the end of the day, people also spend money to step outside their homes and use in real life. So I'm wondering who you're appealing to. How broad do you think the market is?
The market is pretty broad. Because the AR technology opens up the possibility to democratize fashion, we can actually address the audience who would wear something like a mass market. and would be in a like middle and lower price category, also because it's just on the tips of your fingers. And at the same time, with the possibility of implementation of NFTs, we open up this higher price category where digital only items can be priced hundreds, thousands of dollars. And that's an example of what actually like Meghan is wearing the crown now, and this is something that is unique, and it only exists in one copy, and that's like her NFT, and that's why she can wear it, and that can go in the prices similar to the price of the physical item and up. So there is a big opportunity.
Yeah, and I mean, I don't know if you knew I was a sucker for bucket hats, so to bring one on here, an NFT that has flowers growing out of it, I also enjoy what we're seeing here on the show today. But Meghan, I mean, when we talk about the long-term growth potential, right, obviously DressX has shown a lot of the potential here in being the first to move on this space and a leader in the e-commerce digital NFT space. When you look at kind of the mainstream consumer, right, we're talking about clothes I'm wearing right now. I think, I don't know, this might be from Banana Republic. But when we're talking about the opportunities for mainstream fashion to offer some of these things to more maybe applicable prices for mainstream purchasers of clothes, I mean, talk to me about the opportunity there, or if you're looking at this investment space as strictly maybe on the higher end.
Well, you have both. So you have platforms like DressX that can offer a wide range of items. I see DressX as sort of the Net-a-Porter 2.0 of the metaverse. And then you'll have a whole category of higher end luxury items, similar to what we bought. The crown from Dolce & Gabbana, like you said, was over $1 million, and a few of their other items, which were jackets. These are couture pieces. So the industry can span from median to lower dollar apparel all the way up to higher price items like the Doge crown.
And lastly, I mean, Natalia, when we think about kind of how it all works together, right? You know, it's fun to be able to wear wherever you are, right? And that's going to take, I suppose, AR technology coming along a little bit more if you want to just see it around town. But for now, you guys are using this right now on our video call, so there are real, and we've all been working from home, so there are real use cases right now. But I mean, talk to me about working across those. I know I was just playing around with DressX. It seems like it's integrated with Snapchat as well. The technology in that. In terms of being an important piece that DressX and others are working on too. I mean, how far off is that technology from becoming something that, I know young people might be using it now, but everybody might be using it?
So I would say that AR implementation and AR use case for fashion NFTs is something that has a biggest potential so far at the moment, just because we all have our own bodies and we don't need any kind of 3D avatars to appear on the screen. We all have some kind of device which will help us to show ourselves on the screen. And that's why it opens up the biggest market and the biggest opportunity. And that's why we are focusing now on developing the AR fashion NFTs and launching the marketplace where all the items, all the NFTs will be wearable in AR. Of course, the other use cases will follow, and they are already popping up when you can wear some of the items in the gaming environment and virtual world, but it is way more limited compared to AR use case at the moment. Of course, virtual and VR use will be more widespread moving forward, but the biggest opportunity now for sure in augmented reality. That's why DressX is developing and pioneering in this direction.
Well, we're going to have to talk with my team here and figure out how I can get a flower growing bucket hat for the next time we have both you guys on, but appreciate you coming on to chat. The opportunities there, it's exciting times. Natalia Modenova, DressX co-founder, alongside Megan Kaspar, Magnetic Managing Director. Thanks again for chatting with us today.
Smoothie King is one of the world's largest smoothie brands, and the company is coming off an impressive third quarter where same-store sales jumped 18%. Well, now the president of that company is sharing some fresh ideas on how they were able to keep workers off the sidelines and avoid the labor shortages that have been plaguing much of the restaurant industry throughout this pandemic. Joining me now is Dan Harmon, COO and president of Smoothie King, and Yahoo Finance's Danny Romero. Thanks so much for joining us, Dan. Good to have you here. So what's the secret sauce? How were you able to retain your workers during this time?
Well, thank you for having me, and I appreciate your asking. I don't know that it's secret sauce. I've been in the food industry, retail industry my entire life, my entire career, and it comes down to how you take care of your people. And I'm not going to sit here and tell you that we haven't had opportunities, because we have. But we've been able to minimize that by what we call hire them right, train them right, treat them right. And we want to make sure that we're bringing in the right people, because we're a special brand. We believe we're really special, and we're really excited about what it is that we do with helping people live a healthy and active lifestyle. And so we want to attract people that have a passion for that. And so that's what we're looking for. And when we find people that are able to do that and they have a passion for that, and we train them, we have to make sure that they understand our business. They get really excited about being here, and they do a really nice job of taking care of our guests. And so, those are some of the things as we think about it. It's never easy to bring people on. You're always taking a chance, but you certainly see some bright stars. And many of our managers and some of our franchisees started at the team member level. And so there's a real nice career path for those that are looking for it.
And Dan, I was reading your blog earlier, and we've seen a lot of companies offer incentives, also bonuses for employees. What is your take on that, and is it effective?
I'll tell you, I've seen some of those bonuses, and they're shocking what's going on out there. We have had to, in some areas, offer some level of a signing bonus. We like to more think of it a retention bonus. And so if we can get people to stick around for a period of time, we'll give them a bonus on top of what they're doing. But we're really focused on how do we take care of them, and how do we set them up for success and make their jobs easier. We're not the typical fast food or QSR. We don't have the fryers. We don't have the grease. We are fresh. And we have great products that they can be proud of to serve. And when we find those people, I think, the added bonus of being able, from a retention bonus or a signing bonus is just, it's good and it's helpful, but I don't think it's the key to getting the right people in the stores.
And so I guess a question to that is, how many employees have you been able to retain during the pandemic? And also, what's the feedback that you have received from workers in what they are specifically looking for in a company?
So our goal this year was to reduce our turnover by 20%. We haven't quite hit that goal, but here's what I will tell you. And I just left a meeting with our team members in the Dallas area. And we started talking about what is difficult about their role and responsibility, and people obviously came up. And the things that we're doing, making sure that people are going through the right training, that we're being kind, and we're saying please and thank you and we appreciate you. We do regular performance appraisals so that they have something to look forward to. And so in doing that, I think that has set us up and put us ahead. But and that's the feedback I'm getting from the team members. It really will come down to the end of the year number and how does it actually work all the way through. And again, I want to say we're not perfect. We have our opportunities. We have areas where we need to work on. But I truly believe, and I know the team that's working with me, we believe that if we hire them, take care of them, train them, they're going to stick around much longer. And they certainly, when that happens, it makes our guests happier. They see that smiling face coming in the store on a regular basis. We know them by name, and we're really excited to have them. So again, I don't think it's a secret sauce. I think it's about doing the right thing is really what it comes down to.
So Dan, it's my understanding that Smoothie King is a franchised business. So you have franchisees across the country. I'm curious what you've been hearing from them, as they are local small businesses in their communities. Have they had a difficult time staying open? And how are you able to get a handle on quality control when you have these franchisees?
Yeah, great question. I'll tell you, we have, first of all, we have 60 stores that we're operating. And so we have a real good understanding of what they're going through. And so because of that, we've been able to share best practices. We've been able to hold webinars and share with them what is working for us and not working. There are markets where it is definitely much more competitive, and we're all chasing after the same people. And so we have to be a step above, or one more reason why, give them reasons why they would want to join us. We had franchisees that had to go on limited hours. And, it's not something that we want to do. But, if we'll do that for a period of time. I'm really proud to say that, that's not something that we've had to employ or use as a tactic across the entire system. And I see that in other QSRs and or food service establishments, and that's got to be tough. From a quality perspective, we have a team of folks out there that are working shoulder to shoulder with our franchisees. Their goal and their bonus on how do they help them drive top line sales and their bottom line profitability. And so they're invested in making sure that they're successful. And we have a great group of franchisees. I mean, we're successful because of our franchisees and the work that they do. And they're committed to the product that we're serving to our guests as well, and want to make sure that it's right. So yes, there is some that we have to go in there and check, but I'll tell you, I'm really thrilled and proud of our franchise community and how they embrace the brand and what it is that we do.
All right, Dan Harmon, President and COO of Smoothie King. Thanks for making time for us today. Welcome back. Consumer prices inched up slightly in September, climbing 0.4%. And despite the inflationary pressures, LVMH, which owns luxury brands including Louis Vuitton and Christian Dior, posted strong third quarter sales. Here with a closer look at the luxury market is Pauline Brown, former chairman at LVMH of North America and also the author of Aesthetic Intelligence. Karina Mitchell is with us as well. So good to see you. Thanks so much for joining us. I want to start with why we're seeing strength right now in the luxury market. Who is it that's buying these goods at elevated prices?
Well, first of all, the top line shows enormous strength. If you peel the onion, there are areas of weakness, so it isn't a very consistent level of strength. Your answer, or the answer to your question about who is buying, it continues to be the Chinese. That is also, in my mind, the biggest vulnerability for companies like LVMH and its chief competitors.
And how about the supply chain issues? I mean, I have to believe that these luxury goods companies are not immune to that. What are you hearing about supply chain issues for that segment of retail? And are they also experiencing a tough time with labor shortages?
So on the supply chain, it's not hitting them like it hits mass market companies. For one, the bigger categories of luxury, like fashion and accessories, are made predominantly in Europe. And the gateways that seem to be most disrupted are generally between the U.S. and Asia. And so that hasn't been as big a factor. There are some segments of luxury, like watches and jewelry, where there's some parts scarcity, but that's a different supply chain challenge than the one that we're seeing hitting toys and other mass manufactured goods.
Mm-hmm. And what are some of the? Oh, go ahead, Karina.
Oh, sure. I was just going to say that sales actually jumped 20% in the quarter to almost $18 billion, and fashion and leather continued to outperform. But what other categories do well for this? For LVMH, and were domestic sales stronger compared to international sales?
So a few things. Number one, 20% was the top line, and it's a very, very healthy number for such a big company. It's actually pretty dramatic slowdown from the second quarter. So if you look at where the growth was number one in Asia, and LVMH is defining Asia minus Japan, but China is a huge part of that. That was actually up 26% over 2019 levels, which is the baseline they're using. But if you look at Q2, growth in Asia was 34%, so pretty dramatic slowdown. The second fastest region by far was the US. Growth here was up 22%. But again, in Q2, it was 31%. So you see a general softening. With regards to the categories, you're right. Fashion and accessories were a stellar segment for the company. That was really driven by their two largest brands, Vuitton and Dior. Dior especially has almost doubled in size in the last year over 2019. So they're investing a lot in the Dior brand. But the other one that's worth talking about, because it really is moving the mark for the company, is watches and jewelry. Watches and jewelry this last quarter was up 18%. That is not because the core business was up so strong. In fact, the core business was actually only 1% up. It's because they had closed on the acquisition of Tiffany. And Tiffany accounted for the lion's share of that growth. Tiffany actually doubled LVMH's position in watches and jewelry.
Do you have any insight, though, on labor shortages in this segment, especially as we move closer to the holidays and these businesses want to be ramped up and ready for customers?
Yeah. So on the production side, I don't think they're encountering the kind of labor shortages that we see in many other businesses. On the retail side, in terms of people working in the stores, that's a real challenge. That's a challenge for any retailer. Again, it probably not as acute as what we're seeing in restaurants and hospitality, but it's still a challenge. The other challenge that LVMH and many other luxury companies have is attracting millennials. So if you think about the next generation of workers, both white collar and blue collar, they're not that inclined to go into retail. They're not inclined to go into products. They're going to technology. They're going into finance. So they have a bit of a generational gap, which is why some of the strategies they've employed are very much geared toward attracting a next generation employee into the group.
And Pauline, you touched on this a little bit earlier on, but I want a little bit more insight if you can. So LVMH is a bellwether stock for luxury brands, right? And so the stock dropped 9% when China came out with that statement about common prosperity and that it wants to redistribute wealth and make things more equal. So I know Asia had a strong performance, but it did ease, as you say. Going forward, how does the brand deal with that sort of component? Because Asia is such a huge market. And, talking about luxury products like watches and jewelry, we've seen an easing. People are pulling back right now in Asia from buying those sort of items.
Mm-hmm. Well, short to midterm, that's going to be a huge challenge, arguably the biggest challenge for the group, especially as the effects of the pandemic are leveling off. Longer term, what we may see is that there's a bolstering of purchases by Asians who are traveling. So they're going to be less inclined to buy at home, which has been most of where the sales have happened in the last 18 months. But they will reinvest when they get back into Europe, back into the States. And in terms of an appetite for luxury goods, I think that on the one hand, there'll be, I don't think that the demand to buy nice things, especially as there's general prosperity that hasn't existed for all that long in places like China, there's still an enormous interest and appetite for better products and for designer products. The issue people will have is the displays of wealth that have been so prominent these last 10 years or so. And so I think the kind of luxury products that they'll buy will be quieter in nature, probably less likely to buy the big, heavily labeled, belts and bags and over-the-top watches, and more luxury goods that will hold their value, that are a bit less obvious. But wealth will still look for quality in their lives and in their homes.
Pauline, when people are going out to buy these luxury goods and they are willing to spend a pretty penny to do it, are they still choosing to do it in person at the brick and mortar store, or have you seen a real growth in people's willingness to buy these luxury goods online?
You don't see nearly the adoption rates that you see in other categories, and that is especially true in fashion. I also sit on the board of Neiman Marcus, and while Neiman Marcus has a very large and fast-growing online presence, there's no replacing buying things in store, discovering things that you wouldn't have had either the interest or the capability of discovering just by, surfing the web. And then, of course, trying things on. One of the major impediments to selling high-end ready-to-wear in a digital format is sizing. It's just very, very hard to know not only how things will fit until you've actually put it on your body, but also how things will look, how they drape, how they feel. And for that reason, offline sales for high-end ready-to-wear will continue to be, I think, the main source of where people will buy. There are other categories like handbags that will migrate much more easily online, especially for those brands that are already well trusted and have the kind of desirability that drives luxury in general.
Mm-hmm. Good point. It is tough, though, to buy some of those fashion items without trying them on. Pauline Brown, former chair at LVMH North America, thanks so much for being with us.